Let's get started. Here's a brief agenda. This is going to be our normal agenda for market matters that occur right at the end of a quarter. So we'll go through some market data, that price performance of indexes that we follow that are more pertinent, and then we're going to touch on some of the macro variables that might be impacting markets, and then our views, how they might have changed on stocks, bonds, and things like volatility, which are having a bit more of an important impact nowadays. So let's take a look at the economic update. Inflation certainly is something that has been, I think we've been a little bit about a consensus for quite some time. While the decline in inflation is certainly something we should celebrate, down from, I think at the headline level is down from 9% in July of last year. Now we've kind of bottomed out here in headline inflation at 2.7. I think it was July or August of this year. And now, as of the most recent reading, it does appear that inflation is reaccelerating. And what's driving that? Well, you can see these are some of the key factors influencing inflation, things like medical services, shelter, food. Core inflation has been pretty consistent and much less volatile. However, the headline has been really impacted by changes in food and energy prices. Those are areas that we think will be relatively sticky, particularly in an era where we have a very tight labor market. I mean, some of you may be aware that we have a very one of the lowest unemployment levels in many decades. And because of that, we're now starting to see some pricing pressure on wages coming from manufacturing sector. Most recently, United Auto Workers is striking right now for better wages, benefits, things of that nature. Also now healthcare workers are starting to take up striking as an option with an organization like Kaiser Permanente, one of the largest in the United States now. A large component of their employees are striking for better wages and benefits. So we do run the risk, if these types of situations go on for too long, of running into that classic 1970s wage price spiral, which is rises in wages beget rises in prices, and so on and so forth as we continue to go. And that's really what led to structurally higher interest rates in the 1970s, and something that we could be approaching as somewhat of a stagflationary environment. And that's also, I think, more recently in Q3, what's responsible for sell-off in bonds, which happened pretty dramatically. You'll see in just a second. We do think, this is the 10-year, 2-year spread, and we've shown this a couple of times now, but it is one of the key indicators to watch if you're looking for forecasting a recession, because, just to recap, it's not so much the fact that the 10-year versus 2-year bond is negative in yield. That definitely starts the clock on the recession indicator. But once it starts to gain ground back towards a positive difference between the 10-year and 2-year, really is one of the dead giveaways, with almost 100% accuracy that a recession is on the horizon. Now, of course, the timing is undetermined. Looking at historical examples, from the time that the yield curve first inverts to an actual recession can be anywhere between 300 days or a year and 2.5 years. On average, it's about 600 days. Which is a little bit less, of course, than 2 years. So if you use when the curve first inverted, that was, I believe, October, November of last year, then, we've got about a year under our belt here, more or less. And, 6 months forward from now would be about when the actual recession could be upon us. And of course, prices may be reflecting some of that greater likelihood. So, we've been positioning, of course, more defensively, taking profits where available in certain equity positions, and this is just one of those indicators that's helping us inform that we may need to be more conservative. Commodity strength is still something worth noting. This is again another kind of a late cycle dynamic, whereby when you have prices rising as a result of wages rising, one of the ways that manifests itself is in stronger demand for commodities and commodity prices rising. So, after an abysmal start first half of the year, commodities were actually negative, while equity markets were generally positive, particularly in the U.S. Now we have kind of the exact inverse, where I think commodities were one of the only things that worked in Q3. You can see here now they find from the start of Q3 till where we are today at the end of Q3, commodities were up about 10% or so for the quarter. You'll see that here in just a moment. So here's Q3 performance. As I was mentioning, not a lot was positive during the quarter. You can see commodities, the lone standout here, up 10%. Not coincidentally, we had been adding prior to this to our select commodity positions. So on individual stock level, certainly a number of attractive opportunities on the commodity side that have sizable dividends. We'll talk more about that kind of outlook for the commodity sector, energy sector in particular. But outside of commodities, it was a pretty one-way train as far as performance goes. So anything from stocks of international, U.S. small cap or bonds, all coalescing to a return that was negative to the tune of negative 3.5% to negative 5.5%. And again, what was driving the sell-off in equities? It was the sell-off or the rise in bond yields, in our opinion. Looking at the year-to-date picture, it's a little less bleak, if you will, where S&P at the end of Q3 from January 1 was up, call it 11.5%, 12%. International stocks, the MSCI EFO is up 5%. Russell 2000 small cap eked out a gain of about 1%, 1.3%. Commodities up 1.2% for the year. And then we've got, and this is a different commodity index, by the way. And then bonds down 3%. This is after being up 3 to 5% earlier in the year. Looking at or revisiting some of the themes for the second half of Q2, these are we did update these recently, so there is some new information on this page than in previous Market Matters. First thing is that upper left-hand corner, bond market pain. I think that's just kind of a statement of what's happened, but also what's likely in front of us for a little bit more time. And that is U.S. and G7 countries, for that matter, group of 7, have seen their bond markets flip into negative performance territory. This is because yields have risen and prices have declined to reflect that dynamics. It's kind of a seesaw effect with bond prices. And I think the reason we point this out is because there generally are knock-on effects when the biggest market in the world, bonds, have issues, particularly price issues, but also other types of default issues that are now cropping up, and things like high yield. You really have to watch where you're stepping when making new investments. And of course, I think being very mindful of positioning, or even just kind of defaulting to things like cash or cash equivalents, making sure those are at target levels, is a right approach to take. We do still think, though, on the other side of some of this dislocation, there's going to be some great opportunities. So things like high yield bonds or preferred stock, even emerging markets or emerging market debt, those are all areas that we've wanted to gain exposure back after many years of not owning them. We're still not there yet, so we still think there's some prudence to take with our positioning, which is why we've been doing things like trimming back positions that are overweight on the equity side and just trying to remain in that defensive posture as long as we can until opportunities pop up. We talked a little bit already about commodities and the kind of resurgence those are having. A lot of these are supply driven, but also driven by the fact that wages are rising as well too. So there's a demand aspect as well. And the final piece I just wanted to mention here is that the Fed is absolutely an actor that we should pay attention to right now at these pivot points. Generally, if the economy is humming along and you're in a more stable interest rate environment, the Fed is going to be pretty much on cruise control, as they were for the better part of the mid 2000s or 2010s. But now I think it's really important to pay attention to what the Fed is doing and saying, because they're having lots of difficulty forecasting where inflation is going to go, lots of difficulty forecasting what kind of growth rates are going to be popping out of the economy over a horizon greater than 1 year. So in that way, we have to try to see how some of the rhetoric is evolving. And certainly they're indicating that more interest rates are likely possible on the horizon, and that they're going to stay high for a bit longer than maybe most expect. So this higher for longer mantra, we've adopted that pretty much at the beginning of this year. seeing inflation was likely to be more of a problem than most had forecasted. And so our positioning and our performance in our portfolios has really reflected that defensive positioning and taking into account, what we perceive rightly to be a higher interest rate regime, which has led to very positive differences in performance across our bond portfolio in particular, but also alternative assets on the liquid side. We did make a couple of updates to reflect the outlooks within our investment ratings. Small companies, we did have that as kind of a modestly attractive position. We've moved that back to a more neutral position because there generally can be some more sensitivity in the small cap companies during recessionary conditions. Now that it does appear that recession conditions are approaching potentially faster than most expected, we thought the prudent course would be to downgrade that position back to a more neutral stance. Certainly, valuation is playing a part here, and only until small caps get to very, I would say, discounted valuations to the S&Ps when we would likely re-upgrade that or look for new positions there. The other thing I would point out is that we did downgrade high quality corporate bonds to a neutral position. This is because the difference in yield, or the spread as it's called, between what high quality corporate bonds and treasuries and agency bonds are paying has gotten to a very low level. So just using the broad investment grade corporate index, investors were getting paid about 1.7, 1.8% more to own a corporate bond than versus a treasury. Historically, that number has been far higher. Earlier in the years, closer to 3, maybe 4%. And so when that margin of safety shrinks, we just want to be mindful of that and not take any unnecessary risk, particularly in light of the fact when things like 1-year bonds, 2-year treasury bonds, or even agency bonds, if we can look at those in certain account types, are yielding almost as much as corporate bonds, are just thought as why take the risk. Revisiting, did have some commentary on this from clients from the last time. And so just wanted to get a gauge, again, trying to get a sense of, what's the financial system telling us as a forward-looking indicator of what recessionary conditions might look like, or the attached risk reflected in stock prices. And just going back to the Citigroup example, now this chart is updated as of last Friday, and it really hasn't changed. It's declined a little bit from the last time we looked at it. But I think the key point here is that, $40 a share in Citigroup seems to be a really significant price for this company that's held up a number of times over the last 3 years, maybe 4 years. And this is, of course, as the inverted yield curve continues to persist over much of this time. And so all we're saying here is that if Citigroup does break below that $40 level, we have to be aware that that's been breached, and that's sending us a signal that's not a positive signal about perceived risk within the financial system. Just as a side note, our exposure to financial stocks in our single stock portfolio is at one of the lowest levels it's been for quite some time. So certainly we're seeing not a great opportunity necessarily on the financial side. Going back to the U.S. stocks and S&P 500 in particular, we just wanted to point out here that there's a sizable concentration risk now. We've talked about this before. Top 10 companies in the S&P make up roughly 35% of the overall index. And that's problematic because you can see, of course, obviously 2000 was the key example here. But, when you get to very high levels of index concentration, that does have a way of, not working out well over the long term, because when your leaders start to falter in price, then that has a magnified impact on the whole index itself. And it's just, there's a risk now with technology in particular, in the next slide, that valuation could become a greater risk for the top 10. So this is a representation of the top 10 companies weighted in the S&P 500 right now, weighted highest to largest. So number 1 holding is Apple, number 2 holding is Microsoft, 3 Google, so on and so forth. Many of these are in the technology sector. So I think the only non-tech companies right now are Well, Tesla, you could consider probably a tech company to some degree, but it's really an industrial. Berkshire Hathaway is a financial, and then Lilly is a medical healthcare company. You can see, now this is the 490 other companies in the S&P. The middle P ratio is 16.9. And all the top 10 companies have multiples generally that are greater than 20, which is on the high end of valuation range for the index in particular. So all we're saying here is, valuation is getting a little problematic again within the S&P because earnings haven't kept pace with the price growth that's occurred this year. So we would be looking to reduce exposure, not only to these names in general, potentially down to more manageable position sizes, because they've likely done pretty well if you've owned them for the course of the year, but also reducing exposure to the whole sector in general in favor of less aggressively priced sectors. So where are the opportunities? And apologies when we say this, sometimes the font gets a little fuzzy, but this is obviously we still believe very strongly that energy is a great opportunity. And we have increased our allocation to energy over our particularly in our single stock strategy, but also even in things like private market positions. We've added a couple of private market positions within our private funds complex. But that notwithstanding, why is energy such an interesting opportunity right now? It's because, number one, you've got one of the best free cash flow margin profiles that energy sector has had in the better part of the last 13 years, right? So back in 2010, the average amount of cash a S&P 1500 company would split off on the energy side was 2%. Now that's closer to 14%, which is the highest, again, it's been. You can see the average here of about 4%. So excellent profitability. And at the same time, a lot of these companies have delevered or taken their leverage levels down very substantially relative to EBITDA, which is a close cousin to earnings per share. So the amount of debt carried the amount of earnings that a company earns has gone to a very low level relative to the average, no doubt, but also a level it's not been since 2010. And you've got an improving margin profile as energy prices are rising. That seems to be a pretty good combination for total return that we believe is pretty durable right now. And so let's get to the real issue that's vexing the market. And this is not a meme stock. If you had to guess, something down 42% would generally fall into the category of speculative biotech or a SPAC or something, or a high growth tech company that's come back to earth. But would you be surprised to know that it's actually the 20+ year treasury bond over the last call it 2 years or so price performance? And a 42% loss in a bond instrument is not anything, number one, we're willing to tolerate. We've never owned long duration precisely for this reason. But number two, this is just exemplifies the volatility or potential downside in taking on long-term bond obligations that are just at unattractive interest rates. So people that had purchased let's just say a 20-year bond back here, their yield on this position was somewhere in if you remember back in 21, is probably in the mid to high twos. But this is also when interest rates on mortgages were down in the 2.5 to 3 range. Now the yield has risen on the 30-year to 4.7, 4.8, something like that, and that's created a downdraft in price of roughly 42% over that time. This is a total return, by the way. So this is inclusive of any dividends that were paid. So I say that just to say we've had it as a position for some time when we reoriented our priorities for bonds. Capital preservation first, income generation second. This was in mind as to why we decided to flip these priorities. It used to be income generation first, capital preservation second, but when the market flipped and got down to super low interest rates, we had to reorient that strategy or approach for our bond portfolio, and also carved out increasing amounts of fixed income in favor of private market or liquid alternative positions. Just by the way, for anyone that did carve out fixed income positions in favor of things like private markets, your return difference has been very meaningful. But for all the anxiety that the downside in bonds has created, I just thought I would share in context that we're really only back to average levels on the 10-year bond. I mean, going back to obviously 1790 is difficult. So some of these returns had to be spliced together using debt instruments of various types at the time. But the Bank of England, I think, does keep records on long-term bonds, and I think that's part of the calculus here. Was interpolation using B of A 10-year bonds. In any case, Deutsche Bank put this time series together, which I think is really just useful as a reminder. And there are two takeaways here. One is that number one, it didn't take much price loss or yield loss to get to a pretty meaningful price loss in bonds that on long duration bonds. And we're only at the average level of long-term bonds, number one. But number two is rare is the day that any financial instrument works its way back up to the average level and then stops there and turns right around. I mean, I guess it's happened at some points in the past, but generally there's a little bit of an overshoot and an undershoot. And currently we're coming from an undershooting position. The most likely course of or path that we see is that bonds overshoot a little bit to the upside here as reactions take place and momentum takes control. And so that's likely what's going to drive bond prices higher from here, bond yields higher from here, prices down, but also continued volatility and potential downside from here to some degree in equity markets for maybe the next quarter or two. Trying to just give you a sense of what we think that range could look like. This is by, of course, an estimate. This is using average inflation expectations as well as growth estimates and things like premiums to back into where the bonds could go. And this is just a picture of the 10-year bond. And I took this graph on October 1st, and now here it is. So it's the 3rd. This number is now at 4.76 or 4.78. So change is happening very quickly. So we need to be mindful of that. And that's primarily because, again, momentum is taking hold of bond prices right now. And we've broken through some pretty meaningful resistance levels on yields that, once those things are broken, again, the momentum kind of kicks in and shoots up to new levels. And so this is over the next 12 months, we think bond yields could get up to this higher range of somewhere between 5.5 and call it 6.5, 7. Of course, we don't know when and how quickly we'll get there. The faster we get there, of course, the more disruption it would likely occur within things like equities or even other tertiary markets like currency and things of that nature. But what could get us to this level? Well, obviously, it's an election year next year, so the campaigning has already started. But we have to come to terms with the fact that as a government, there are significant amounts of new debt issuance that need to occur to just pay the bills that are currently already obligations of the U.S. government. Inflation has been pretty resilient. It's as we showed earlier, it's bounced off a low level that we saw 2 months ago and now on the rise again, at least in the headline number, driven by things like energy and food. But also, forecasted government budget deficits are expected to be much worse than maybe people had thought about 5 years ago. And so we have the largest budget deficit in the U.S. Outside of a wartime period ever. And if we hit a recession, of course, I think we know the playbook is going to be more government stimulus, which will make that budget deficit even more exacerbated. So we do think that there's not going to be a collapse in bonds. So that's not what we're saying at all here. But getting to a more normal range of bonds, taking into account these factors we just pointed out, means that we think bond yields have to go higher, which just will take some adjustments, but if you're disciplined about it, it's not going to be too disruptive. And the other thing I just wanted to point out here is this is a picture of our two kind of proxies for volatility. One is the CBOE Volatility Index or VIX index. This was as of October 1st. On October 3rd, now here we are. VIX is at 20, so it's rising now off of a lowish level. So volatility is rising. And then this is high yield bond spreads in the orange line. And you can see we touched on some very low intermediate term spreads, and now we're on the rise again, reflecting maybe higher default risks as a recession approaches. And so what we're saying here is that, we've kind of troughed out at complacent levels within volatility and other indicators showing that the markets were a little complacent into the end of Q3. And now, into early parts of Q4, we think that, best case, stocks would probably be flattish at the index level. Obviously, individual names would be can have their own, different paths. But you've got now equity volatility rising and high yield bond spreads rising. So it just sets up for a situation where we've got a need to be a bit more conservative and wait for opportunities to come our way. So here's just some key takeaways that I just wanted to point out here that, again, we did update all these more recently. So the main point I think the first comment makes is that 2023, if you look at it from a fundamentals standpoint, has been a year where the rally that's occurred has really been much more on flows than fundamentals at the index level. Of course, technology and other places might have some fundamental reasons for why they've risen the way they have, but the rest of the market, it's been a pretty challenging earnings environment. And now we're layering on some macro challenges that previously had been very muted. So at 19 times earnings, that's what the S&P rough forward earnings is at the moment on S&P. Historically, that number is 16 times. So if we get just back to a more average level of valuation, particularly when now there's competition for capital in the treasury market that's reflecting decent rates of return, we think that this multiple likely has to come down a little bit. And to reflect that more uniform or better opportunity set on the bond side. So again, this is why a flattish base case for Q4 and into early next year is likely what we're working with. As we said at the end of Q4 or Q3, and actually I think at the middle part of Q2, now is an excellent time to be trimming back technology positions or equity positions that have worked pretty well so far this year, for all the reasons I mentioned above. But this has been a priority of ours to rebalance accounts where necessary on a more targeted basis, and looking at ways to deploy that capital when opportunities come back that are better. We still have a preference for alternative strategies over bonds. This has worked really well for us this year, particularly as now the bond market is negative in return, negative 3% for the quarter. And as a way of mention, our liquid alternative strategy is actually positive, is positive for the year and actually positive for the quarter. So doing exactly what we would hope it would do during these types of strenuous periods for markets. And it is worth pointing out, I'm talking about the risk and duration for us, and we talked about this last time. As yields creep higher, the willingness of our investment team to look at slightly longer bonds gets more probable, but certainly not out to the level where we were taking on substantial price risk. So incrementally looking in that 3-year, maybe even into 4-year range, if yields get higher from here, for those accounts where we're managing individual bonds, is something that we'll look pretty closely at. But it has to be very targeted, and we take that decision very carefully. So it's nothing we would take very lightly. Just one kind of question looks like came in is talking about with Treasury yields rising, would there be any other areas in the maybe equity space or alternative space to look for yield that might not have as much of a tie to the fixed income markets? And I mean, absolutely, we're certainly open for other ways in which we can generate durable yield. The goal of just going back to what the goal of some of our private markets strategies, income generation that's durable, that has no real correlation to the stock or bond market on the private side. We've certainly found some really unique opportunities there, particularly in things like private credit or even the natural resources sector. And then on the liquid side, Absolutely. There's definitely some great strategies out there we've added and continue to have in our toolkit that we've added to. And on the equity side in particular, yeah, I would say things like tobacco stocks or energy, or business development companies are all certainly stuff looking at. We do have exposure to energy, not the other two. So yeah, we're definitely equally open to those types of opportunities when they come up. But for right now, we're pretty comfortable with the earnings profile of energy and what that represents for us. Thanks for tuning in, and look forward to speaking to you sometime soon.